should you invest in buy-to-lets or HMOs? It's one of the biggest questions in UK property investing right now, and the wrong choice could cost you tens of thousands of pounds. And you've probably heard two completely opposite opinions. Some people say stick with buy-to-lets. They're simple, stable, and proven. Others say buy-to-let is dead, and HMOs are where the real money is. The problem is, both of these opinions can be right depending on your situation. I own a buy-to-let and I own a HMO. I put roughly £40,000 into each, and one makes me 250 quid a month and the other makes me 1,200 quid a month. So why do I still own both? And which one should you actually choose? My name's Jim and I still work full time, and I'm building my property portfolio on the side. So if you're thinking about getting involved in property, make sure you subscribe to the channel and let's get after it. First off, let's talk about why so many people still invest in buy-to-lets. And I'll walk you through exactly how my buy-to-let deal worked, so you can see what it actually looks like in practice. So if you've got £40,000 saved up and you want to get into property, here's one way you could do it. Now the deal, I found a 3-bed terraced house that needed a bit of updating. Nothing structural, just a bit dated. And the purchase price was £105,000. To buy it, I needed a 25% deposit. That's £26,250. The stamp duty on a second property was about £3,150 and the legal fees were about 1,500 quid. So before I'd even picked up a paintbrush, I was in for around £31,000. Then the refurb, rewire, new bathroom, new boiler, and I redecorated throughout, which cost around £15,000. So the total cash needed is roughly around £40,000 to £45,000. So there you go, 40 grand and I owned a rental property. No bridging finance, no development loans, no private investors, just straightforward residential mortgage and my own savings. So if you've got £40,000 and want to keep things super simple, this is probably the most accessible route into property. Now that's assuming you have £40,000. And I actually pulled money out of my own house to get this deposit pot. Now what's the process actually like? Well, the mortgage was approved in a couple of weeks. It was a standard high street lender. There was nothing complicated. Solicitors knew exactly what they were doing, so it was a straightforward purchase. And the refurb took about 6 weeks. Nothing major, just cosmetic stuff. And a tenant was in within 2 months of completion. And the outcome, well, the current rent's £750 a month. Now we're actually in the process of moving mortgage products onto a cheaper rate, along with upping the rent. So soon the monthly profit will be £250 to £300, which is an annual profit of £3,000 to £3,600 per year. And the return on my £40,000 is 8 to 9%. Now it's not spectacular, but here's the thing. I barely think about this property. The tenant's been there for ages and the rent just comes in. And we only have minor maintenance issues, which is pretty normal with property. It just ticks along in the background. And if I ever wanted to sell it, I'm selling a standard 3-bed terraced house. First time buyers, families, and other investors. Everyone understands what it is and there's a big market for it. So if you're looking for low hassle, steady returns, and a simple entry point, buy-to-let is worth considering. So the barrier to entry is around £40,000. The complexity is pretty low, and in my opinion the risk is low as well, but the returns are pretty modest at best. Now let's talk about HMOs, and again I'll walk you through exactly how my deal works. But first, and this is the most important thing to explain properly about HMOs, you need access to a lot more capital. So if you're thinking about HMOs, here's what you actually need to make it happen. Not £40,000, you need access to around £340,000 and potentially a lot more depending on where you are in the UK. Now you don't keep all of that money in the deal, you get most of it back, but you need it up front to make the deal happen. And let me show you how. So I found this 3-bed terraced house that was really good for a potential conversion. Good location, right size, and no Article 4 restrictions. And I paid £134,000 for it. But I couldn't use a normal mortgage to purchase it. The property needed too much work to it. So I used bridging finance. Bridging lenders will lend on stuff high street banks typically don't touch, but it's more of a short-term loan and it's a lot more expensive. So I borrowed 75% of the purchase price. So I needed around £33,500 as a deposit for the bridging loan, plus stamp duty, plus legal fees. So this was £45,000 before I'd done any work. Then the big boy, the refurb, and this wasn't a lick of paint. We took it completely back to brick, reconfigured the layout, added en-suites and studios to each room. There was new electrics, new plumbing, new heating, and fire safety upgrades, the whole lot. And the refurb cost us around £150,000 to £160,000. I used development finance for this part of the process, and they released funds in stages as the work progressed. But I still needed capital to bridge the gaps, and private investor money covered that to the tune of around £60,000. Now all of this finance costs us money, ranging from a couple of % per month to to 10% a year for private investors, which meant the total project cost around £340,000. So just to be crystal clear, if you want to do a HMO conversion like this, you need access to serious capital. That could be your own money, bridging finance, development finance, private investors, or a combination of all. But you need to have access to it. Now here's where it gets interesting, the refinance. Once the property was finished and tenanted, I got it valued commercially based on the income it generates, and we got a valuation of £400,000. And I refinanced at 75% loan to value, pulling out £300,000, and I spent £340,000, which meant I left £40,000 in the deal. Similar to the buy-to-let, but a completely different journey to get there. And the outcome? Well, 6 rooms, and each room is rented out between £625 and £725 a month, including bills, with a total rent roll of £4,100 a month and a profit of £1,200 a month, which gives us a yearly profit of £14,400. Give me a juicy 36% return on my money left in the deal, which in my opinion is the most important metric in property investing. So if you can access the capital and you can handle the complexity, the returns are significantly better with HMOs. The barrier to entry is a lot higher. You simply just need more money. The complexity is well higher as well. It's a big build with lots of things to consider, which ultimately means it has higher risk, but this is why you get higher returns. So let's put these side by side, because this is where it gets really interesting. Now the capital needed for a buy-to-let is around £40,000. For a HMO, £340,000 plus. And the capital left in the deals is around £40,000. Now, depending on loads of different things, you might be able to get this capital left in number lower. And as you develop as an investor, you'll get better at this. I know loads of things to reduce the amount of money I leave in deals moving forward. And the monthly profit for a buy-to-let is around £300 tops. HMO, £1,200. And the return on the money left in, we're talking 8 to 9% for a buy-to-let or 36% plus for a HMO. Similar money left in at the end, but wildly different returns. But this is the crucial bit. It's completely different barriers to entry and risk. With the buy-to-let, I needed £40,000 and that was it. And that's how much I was exposed to from a risk point of view. With the HMO, I needed access to £340,000. And yes, I did get most of it back, but I had to find it first. I had bridging debt, development finance, and private investor money. All needed to be paid back or serviced during the project. If something had gone wrong, if the refurb went over budget, if the valuation came in lower, and if I couldn't refinance, I'd have been exposed to a much bigger number. So ultimately, the bigger the risk, the bigger the reward. And that's the trade-off. And that's the key thing to understand. So you need to ask yourself these questions. How much capital can you actually access? And how much risk can you handle? So let me give you a little framework for thinking about this. Because I've been there, trapped between the decision about which direction it should take. And it's not easy. Property investment sits on a spectrum. On one end, you've got low risk, low returns, low hassle. On the other end, you've got high risk, high returns, high complexity. Buy-to-let sits on the lower end. You need less capital and the financing is simpler. And the management is way easier. The exit's cleaner, but the returns are modest, 8 to 9% on your capital if things go well. Maybe 5 to 6% in some areas. And naturally, lots of people would just prefer to invest into index funds because the returns are slightly higher and it's a much simpler process. But HMO conversions sit towards the higher end. You need access to more capital. The financing is a lot more complex and there's more involved with the management. And the exit is a bit trickier and you're selling to a smaller pool of buyers. But the returns are significantly better. 30+% on your capital left in is achievable. Now, neither's better or worse, they're just different positions on the spectrum. So the question is, where do you want to sit? And if you're starting out and have limited capital and want to learn the ropes, the lower end might be the right position for you right now. If you've got access to more capital and you're more comfortable with complexity, and you want to build serious cash flow, the higher end might be worth exploring. And there's no wrong answer to this, it just depends on your situation. Now here's the bit most people skip, but honestly, it matters more than any spreadsheet. Before you decide between buy-to-let and HMO, you need to be honest with yourself about a few things. How much risk can you actually stomach? With my HMO, I had months where I was juggling lots of things. The bridging finance, development finance, paying the builder, and waiting for refinance valuations to land. At one point, I had over £300,000 of debt on a single building site. If you're someone who loses sleep over that kind of exposure, HMOs might not be for you, even if the maths makes it seem like they're more optimal. So be honest with yourself, some people thrive on that pressure and others hate it. Neither is wrong, it's just how much hassle can you handle. Now I work full time and I'm building this on the side. My buy-to-let I rarely think about. Rent comes in, the tenant's happy, and there's not a lot to manage. My HMO, there's a lot more moving parts. More tenant turnover, more compliance, more stuff that needs my attention. So if you've got limited time and energy, a portfolio of boring buy-to-lets might actually make you happier than one high-maintenance HMO, even if it makes you less money. So the key question is, like most things in life, what's your actual goal? If you want to replace your salary quickly, you need cash flow. That probably means HMOs. If you want to build long-term wealth slowly with minimal stress, buy-to-lets might be perfectly fine for you. And if you want to build a property business, you need scale, which probably means HMOs with proper systems. So before you run the numbers, ask yourself, what am I actually trying to achieve here? And what kind of life do I want to be building? And there's no one-size-fits-all answer. What matters is what fits your risk tolerance and your goals. So what am I doing? Well, here's my approach, and it might give you some ideas for your own strategy. I'm not 100% buy-to-let, and I'm not 100% HMO. I want to build a balanced portfolio. HMOs for growth and cash flow 100%. These are the engines: higher returns, capital recycling, the deals that actually move the needle. My goal is 10 to 15 HMOs over the next few years, with a longer term goal being 50. That's where the serious income comes from. But having buy-to-lets for stability, lower returns but lower risk. A solid base that keeps everything ticking over if something goes sideways with a HMO. Now at the moment, I'm not actively buying more buy-to-lets, but I'm not getting rid of the one I've got. Then ultimately move on to blocks of flats eventually. This is a longer term play. Multiple units in one building. You get some economics of scale and the shared costs. I think about this as it's somewhere between a HMO and a buy-to-let. Better cash flow than a buy-to-let, but not as risky as a HMO. And that's the direction I'm heading in. How I'm going to be doing this is by working with private investors. To build a diversified portfolio like this, I need capital. And that's more capital than I've got my own bank account. I can find the deals, I can manage the refurbs, and I can run the properties. What I need is partners who can provide capital and want exposure to these returns without doing any of the work themselves. So if that sounds appealing to you, I have an investor waitlist in the description below. Please fill that out and let's see if we can work together in the future. So buy-to-let or HMO, here's how I'd think about it if I were you. If you've got limited capital and want to get started, buy-to-let is the easier entry point. £40,000 gets you in, you learn the ropes and you build from there. Don't let anyone tell you buy-to-let is dead. It's not dead, it's just lower returns now. So if that fits your situation, it's a perfectly valid strategy. Now, if you've got access to more capital and you can handle the complexity, HMOs will generate significantly better returns. But go in with your eyes open. It's a lot more work, it's a lot more risk, and you need access to serious money up front, even if you get most of that money back upon refinance. And if you're serious about building long-term wealth, you probably want to be doing both. But don't put all your eggs in one basket. Balance growth with stability. And the real question you need to answer is, where do you sit on the risk spectrum? Lower risk, lower returns, lower hassle, buy-to-let. Higher risk, higher returns, higher complexity, HMO. Now neither is wrong, it depends on your situation, your goals, and honestly, what lets you sleep at night. And remember this, the best strategy is the one you can stick with. So if you're watching this and trying to figure out what your next move should be, here's what I'd do. Number one, work out how much capital you can actually access. Not just what's in your savings, what could you realistically pull together if you needed to. Number two, be honest with yourself about your risk tolerance. If the idea of £300,000 of debt makes you feel sick, that's useful information. Number three, run the numbers on both strategies for your area. What the buy-to-let returns look like, and what could a HMO realistically return in your area. Number four, talk to people who've done both in your area and learn from their mistakes. That's the starting point. So that's the comparisons. Buy-to-let versus HMO. Similar money left in, completely different paths to get there. Completely different risk profiles and completely different returns. For me, it's not about which one is better, it's about which one fits you. So if you want to see how I structured my HMO to hit 36% returns, the financing, the refinance, and the 8 policies I sidestep, I break it down all in this video. And if you want to follow along as I build my portfolio, the deals, the numbers, the mistakes, make sure you subscribe, because I post a new video every single Monday. And I'll see you guys in the next one.